Welcome to part 3 of our course. In the previous part, we talked about how to predict the high and low of wick with high accuracy. All the concepts explained earlier now needs to be combined in order to predict the rightful market reversals. So in the first part, we actually talked about how to predict the high of day. Then in part 2, we talked about how to get high or low of the week. So those two concepts now needs to be combined in order to get the rightful market reversals. Today we are going to talk about how to predict the market reversal using the Fibonacci retracement tool. So this is now basically linking two different wicks. That is, after obtaining a high of the wick, we expect to see another wick initiating. But the point of that wick initiation, we will use the Fibonacci retracement tool. Before we jump into the whole video, make sure you hit the subscribe button if you haven't done so. Please check out our free signals Telegram channel where we share free signals, trading advice and support. It will definitely help you here and there. The link is down in the description below. Make sure you have somewhere to write and take some notes so that you fully comprehend everything we will talk about. And do not hesitate to ask any questions in the comment section below. So in this part, we are going to talk about one, we'll just have a revisit of the Elliott waves that we talked about in the last part. Then we'll talk about the Fibonacci retracement tool. We'll have a definition of what this tool is all about. We'll also talk about the useful Fibonacci retracement tool zones. There are only a few useful zones and we'll talk about them. Then we'll go over the charts to show you how to expect and how to actually carry over the operations in real life practical examples. So in the last part, we talked about the weekly structure, whereby all the concepts were meant to give you the ability for you to anticipate and expect or predict where the high of the week will occur. So in this scenario, we talked about getting the average daily range of these 2 days in order to anticipate this, as well as using these number of waves, which are 1, 2, 3, 4. If you haven't watched that video, you may actually check. The link is down in the description below. So today we are going to talk about how to anticipate a point here whereby we initiate another week of rise, or if we are in a downtrend, another week of drop. So this is basically going to be this in summary. So we have a week of rise like this one. In this case, I only drew it as a straight line, but in actual fact, it will look like it will have these segments or these waves. So in this case, I only drew it as a straight line. So after this week of rise, we expect initiation of a second week of rise, like this scenario. So we are going to talk about how to predict this point, whereby we are now initiating another week. So it's basically catching the low of the next week after the first has been completed. So getting this this point will actually give us an edge in actually getting all these pips, and as well as how to predict this point. So we'll basically have 3 weeks of rise. So these linkages are what we are interested in this video. So the Fibonacci retracement levels are basically horizontal lines that indicate where demand and supply zones are likely to occur. They are based on Fibonacci numbers, and there is a history behind these two. It was actually created by some guy who had, I'm sure, a name called Fibonacci, and he created from mathematical calculations. That's how he actually got these horizontal line values. So each level is associated with a percentage. This percentage is basically how much of the prior move the price is retraced. So let's take, for instance, the price has gone from A to B, then the price is retraced. So we are basically measuring the amount of retracement the price has given us. So let's take, for instance, the price is retraced to this point. We might say it is retraced 10% of the prior move AB. Or if it comes at this point, we would say the price is retraced 50% of the prior move AB. Or if it goes to this, we would say it is retraced 100%. So that is basically what the Fibonacci 2 will be helping us. So the Fibonacci retracement levels are 23.6, 38.2, 61.8, and 78.6. However, there are only a few that are of importance to us, and that is what we will talk about in this video. So here's how you can use the Fibonacci 2. So when these indicators are applied to a chart, the user chooses 2 points, which are basically a lowest point and the highest point. In our case, the first point is the low of the week. Then the second point is the high of the week. After obtaining these points, we now need to apply the Fibonacci retracement 2. So once these 2 points are chosen, the lines are drawn at percentages of that move. So let's take, for instance, we are saying we have our first week of rise, right, which has 5 waves, as we talked about in the part 2 of this course. Then after 5 waves, we say this is the point A, point B. We apply the Fibonacci retracement 2. It will look like this sort, and we'll have the percentages at this end. So although there are several zones on the Fibonacci retracement 2, only 2 are important to us, and these are the 38.2 and 61.8 retracement levels. Of course, there are a lot of retracement levels, but these are the only ones that are important to us. And as always in trading, we have to be consistent with our concepts. We do not need to change whenever we want, but we stick to the only concepts that we have. That is how we can stay consistent, even making money out of it. Algorithmic trading is the only answer to making consistent profits. So that is why we say 38.2 and 61.8 are the only retracement levels that we respect. So the sequence will be as follows. After week 1 of rise, right, we expect the price to retrace to 61.8. Then after week 2 of rise, we expect the price to come to 38.2 retracement level. Basically that. So the first thing that we have to do is actually to get high of this week using the methods that we discussed in part 2 of this course. After getting the high, we have point A, which is the low of this week, and point B, which is high of this week. Then apply our Fibonacci retracement level. Then at 61.8, that is where we actually put a zone to expect the market to come back in that zone, so that we'll actually make use of that zone. Then after week 2 of rise, we mark point A, which is the lowest point, or actually in this case, which will be 61.8 of the of the first week, then the highest point of this week that we would have attained by the methods we talked about in part 2. Then apply the Fibonacci retracement 2. After that, we expect the market to come back to 38.2. After price reaches the 38.2 zone, that is where we start to look for entry opportunities. So let's go over the charts and illustrate how everything goes. So this is GBP against USD, and I'm going to use the 1 hour. As you can see, we are on the M15 time frame. I'm going to use the 1 hour time frame to do the explanation. So as you can see, let's start on the higher time frame so that it will be easier for us to see. From this higher time frame, we can also apply all the concepts that we have learned since part 1. And from that application, we can see that this was another zone of initiation, whereby we are now starting to count the 3 weeks of rise as seen from our template. So after that, we go on H1, we can see that this week started at this point, and the high, let me use some highlighters, this week had its low at this point. This was the low of this week at this point, and this was the high of this week at this point. We could actually anticipate this high after the market had moved from this move. The first move, right? This was 1, 2, 3, 4, and 5. And at 3, we could actually anticipate this move and calculate how much pips we were going to expect at this move. And that was actually explained in the part 2 of this course. So after obtaining the high of this week, we expected the market to retrace to 61.8 retracement level, and using our Fib 2, this is point A, right, to point B, we can see that the market actually respected our concept to anticipate market reversal. This is where it retraced, which is basically 61.8. So as we said that after the first week of rise, we now expect the market to retrace to 38.2 after this move. So let's apply again on the next week. This was the following week, whereby we had 1, we had 2, we had 3, we had 4, then 5. And we could also anticipate this high of the week using the methods that we talked about in the part 2 of this course. So after having that, we are now applying our Fib 2, whereby we expect the market to retrace at 38.2, and that is exactly what happened. So this was also a point that we were going to anticipate its reversal at 38.2. So basically this was to show you that these concepts hold. However, there are variables within the market. It's not something that is uniform all the time. Things change and structures change. Whenever these changes, we will need to look for application of the part 1 of this course, looking for the low and highs of days, so that we can be involved within the market in the direct direction of the market. So basically it will need you to open the mind, apply all the concepts that you've learned from part 1, part 2, and incorporate this part as well in order to have it as a complete guide. So that is what we were going to, that is what actually what I had today, what I wanted to show you. And we have come to the end of our part 3 of our course, and have a good day.